Silver just exploded higher. In less than 24 hours, silver rocketed more than 22%, ripping from the mid-60s straight back into the high 70s. If you blinked, you missed it. And if you're only watching headlines, you probably still don't understand what just happened. Because this move wasn't random, it wasn't luck, and it definitely wasn't retail traders suddenly waking up optimistic. This was pressure releasing, leverage snapping, and reality forcing its way back into price. As I'm recording this right now, silver is trading around $78 after tagging lows near 65 just yesterday. That's one of the fastest upside reversals we've seen in years. At the same time, Bitcoin surged over $10,000 in a single day, reclaiming the $70,000 level. The crypto market added hundreds of billions in hours. US stocks erased an entire sell-off almost instantly, with major indexes ripping back to highs. When you see silver, stocks, and crypto all move violently together, that's not coincidence. That's a system releasing tension. This is exactly the kind of moment we focus on here at Past and Profit, because the biggest mistakes investors make don't happen during slow markets. They happen during fast ones. So before we go any further, quick reminder, especially if you're new here, if you value calm, data-driven breakdowns that cut through the noise, hit like and subscribe. It helps the channel, and more importantly, it keeps you grounded when markets are doing their best to shake you out. Now, let's break this down step by step, because the question everyone is asking right now is simple. Did silver just put in a bottom, or is this just another trap? And the answer is not emotional, it's structural. Yesterday, silver printed its lowest price of this correction, right around 65. Sentiment was awful, panic everywhere, people calling the bull market dead. And that's exactly when the reversal started. In less than a day, silver erased weeks of losses. Moves like that don't happen in calm, healthy markets. They happen when positioning gets extreme. They happen when leverage gets flushed out. This wasn't new money rushing in. This was weak hands being forced out and strong hands stepping in. You can see it across every risk asset. Bitcoin was crushed for weeks, down more than 30% from recent highs, and then suddenly ripped higher in a single session. Ethereum surged. Altcoins jumped even harder. Stocks that were red one day were green the next. That tells you capital didn't disappear. It moved. It waited. And then it came back fast. Here's the key point most people miss. Violent moves down often lead to violent moves up. That doesn't mean the ride is over, but it does mean something important changed. Pressure was released. Forced selling ran its course, at least temporarily. To understand why silver snapped back so hard, you have to look beyond price and into the mechanics of the market. One of the most important signals right now is the silver lease rate. In simple terms, that's the cost professionals pay to borrow physical silver. And right now, that rate is elevated. That tells you physical silver is tight. If supply were abundant, no one would be paying up to borrow it. High lease rates don't happen when demand collapses. They happen when physical metal is hard to find. At the same time, silver remains in backwardation. That means near-term prices are higher than future prices, which is the opposite of what you'd expect in a market drowning in supply. Backwardation is a physical signal. It tells you buyers want metal now, not later. Now layer on open interest data. During the crash, speculative positions were flushed out aggressively. Open interest dropped sharply, especially in precious metals. That's what you want to see if a market is trying to reset. Speculators leave first, then price stabilizes. The new positions build on a cleaner base. Open interest doesn't usually bottom at price highs. It bottoms near price lows. Another massive factor here is China. Physical silver inventories in Chinese exchanges have been draining for years. The pace recently has accelerated. Low prices don't scare physical buyers. They attract them. When paper markets push silver down fast, physical buyers step in and remove supply. That's exactly what's been happening. You don't see it on a candlestick chart, but you see it in vault data. This is why price alone can lie to you in the short term. Paper can push price, physical decides availability, and those two forces are constantly fighting each other. Now let's address the elephant in the room. Risk. Just because silver bounced hard does not mean all danger is gone. This channel doesn't do blind optimism. Historically, Bitcoin bear markets have been deep. Even in strong long-term uptrends, Bitcoin has seen drawdowns of 70% or more. If broader risk markets face another wave of deleveraging, silver can absolutely feel that pressure again. Correlations matter in the short term. That's why confirmation is important. A bounce is not the same as a base. Silver needs to hold levels, build support, and absorb supply. That takes time. But what we can say with confidence is this: the selling that drove silver down to 65 was not driven by collapsing fundamentals. It was driven by leverage, and leverage is finite. Zoom out to the long-term picture for a moment. When you adjust silver prices for money supply growth, the recent move still looks like a retest, not a breakdown. Silver hasn't even challenged its historical extremes yet, and some people are already writing it off. Perspective matters. Big trends are never smooth. If you thought silver was going straight up forever, this market was always going to hurt you. Now let's talk about silver miners, because this is where things get really interesting. Historically, silver miners are leveraged plays on the metal. In past bull markets, when silver rose a few 100%, the best miners rose multiples of that. And yet, in this cycle, miners have lagged badly. Even during silver's big runs, many mining stocks barely kept up. Why? Because analysts were slow to adjust. Valuations were stuck in the past, pricing silver as if it were still a $40 metal. That changes when earnings start hitting. And earnings season is approaching. Higher realized silver prices flow directly into cash flow. When the numbers show up, models get updated, and when models get updated, capital follows. There's also a structural limit most people don't think about. Banks don't have infinite balance sheets to suppress metals forever. Paper markets rely on balance sheet capacity. Physical demand doesn't. When physical demand overwhelms paper supply, repricing happens. Not gradually, suddenly. This brings us to the next critical window. Upcoming delivery periods matter. Open interest remains large relative to registered inventory. If delivery demand stays elevated, stress builds. Systems don't fail when everyone expects them to. They fail when pressure quietly accumulates and then snaps. So where does that leave us right now? Silver just staged a violent 22% rebound. Risk assets across the board snapped higher. That tells us forced selling likely peaked, at least for now. Structural indicators like lease rates, backwardation, and physical flows tell us this was not a collapse in demand. It was a flush. At the same time, macro risk hasn't vanished. Volatility is still high. Bitcoin remains a key signal to watch. If it stabilizes and builds a base, it supports silver holding and pushing higher. If it rolls over again, expect more turbulence. That's not fear. That's reality. The biggest mistake you can make right now is letting emotion drive your decisions. Panic selling near lows hurts just as much as chasing tops. Strength in markets comes from understanding, not prediction. So ask yourself this. If silver were truly broken, would it snap back 22% in a day? If physical demand were weak, would lease rates be high and inventories draining? If this were the end, would volatility be this violent? Or would it be quiet? If this breakdown helped you make sense of what just happened, drop a comment and let me know whether you think this move was the start of a larger trend or just a relief rally. Share this with someone who panicked yesterday, because these are exactly the moments where perspective saves money. And if you haven't already, make sure you're subscribed to Past and Profit, because the next few weeks in silver are going to test everyone's patience. Silver didn't rocket higher by accident. Pressure built, leverage snapped, and reality reasserted itself. Whether this is the beginning of the next leg or just the first signal, one thing is clear. This market is far from finished.